welcome in Pankaj Murarka, he's CIO of Renaissance Investment Managers. Pankaj, in case you heard that, just blame it on me being maybe a bit sleepy on a very sleepy day for the markets, I must say. But thanks for joining in, Pankaj. Always good talking to you. And I wonder if you reckon that this is how the near term might be, because this is just lack of clarity on a number of factors which might impact growth, right? And it's not that the earnings season set the stage on fire. So how do you look at what the markets could do in the near term?
You're right, Neeraj. I think markets could be in a range in the near term, let's say over the next 6 to 8 weeks, because I think India is in a perfect Goldilocks kind of environment where the economy is still growing at a pretty healthy 6.5% or thereabouts. So it's neither too hot, as we say, in terms of overheating, and it's neither a slowdown. So right in the middle kind of a thing. And I think it'll not be a bad idea for markets to consolidate for a while, given the sharp up move we have seen in the last 8 weeks or 12 weeks in the markets from the February low, and more importantly, the kind of volatility that we have seen in the first half of the year. So I think the second half of this year could be a more steady in that sense, and I still think I still remain in the camp. I still believe that we'll see growth recovery in the second half of the year, and that will take markets to new all-time high before the end of this calendar year. So I think probably it's a good market for stock pickers where you can just go out and invest into individual names and probably stay invested for a period of time. So I think it's a good market for long-term investors.
Pankaj, morning. Alex here. The last time I was here when you spoke to us, I remember that you were out scouting for slightly smaller IT names with significant revenue potential. I'm just wondering what you found and what the prospects are, whether anything has changed based on the earnings season that you've just seen and the fact that seemingly discretionary spend is not yet taking place.
You're right, Alex. Given that this whole uncertainty around tariffs have lingered in US and there's an overhang on the global economy all through the last quarter, large companies, global companies, and large US companies are holding back discretionary spends because they're busy dealing with uncertainties around tariff and what would the impact it will have on their own businesses. As a consequence, obviously, that growth uplift or the spending uplift that was expected to happen in IT has got pushed back again. But I can say from my experience that now this is the fourth successive year where we are seeing, discretionary spends not happening. So all I can say is it's a matter of time because large companies, global companies cannot hold back discretionary spends for a longer period of time, meaning they will have to spend because these IT spends are essential to for the future of the business to get their business ready for the future in terms of whatever technological changes are happening. So I think it's there out there, but probably what we need is a stable macroeconomic environment and a probably more certain environment in US, which so far has been elusive because of this tariff overhang. And as a consequence, there's been some growth pressure on the larger cap IT companies, whereas small companies have still done pretty okay. So I still believe that someone having a slightly more medium term view, IT is a good investment, space to be in, and then investors need to pick and choose stocks from large caps and mid caps or small caps. But I think we are near the trough in terms of IT spending cycle.
Pankaj, hi, good morning. Tamanna here. I'm wondering how you saw the TCS news that they're going to cut about 12,000 jobs, that's 2% of their workforce. Brings into place a lot of questions on transition to AI. Is this margin management? Is this smoke signals of the demand pain now showing up? How did you look at it?
Well, you're right, Tamanna. I think I would think it's a combination of the first 2 points you mentioned. So there is obviously a reorg of the skill sets within the organization because if AI is going to change the world, before these companies go out and change the world, they will have to change themselves internally in terms of, and they'll have to adapt AI themselves before they can go and implement for clients. and which effectively means these companies need to reorg their workforce in terms of skill sets. And in a large organization like TCS, as you rightly said, with 6.4 lakh employees, 2% of workforce being let off, I don't count that as anything extraordinary. Yes, to some extent, given the challenges on the business, given the TCS's size and scale, is also margin management. So these companies eventually have to manage the ship, because eventually you have to strike a balance between demand and supply. And if the demand side is weak, then the supply needs to be managed in that context. And the fact remains, as I said, that we are in the fourth successive year of slowdown or moderation in global tech spend. So this is one of the longer drawn slowdown, I would reckon, that in the context of whatever I have seen of this industry in the last 30 years, uh, for whatever multiple reasons. Earlier, first because in 2022 and 2023, because of sharp rate rise in US, and then now because of the election uncertainty, and once we got with election uncertainty, we got tariff uncertainty. So last 3.5 years, global tech spends have been held back. But my experience of seeing this industry, these spends will come back, because generally it's a very prolonged cycle. You do not companies cannot hold back spend for such a long period of time. So I think for TCS, yes, it's both, right? In terms of reorg of the organization in terms of skill sets, and also probably right sizing of the ship, keeping the near term demand supply over the next 2 to 4 quarters in mind.
I'm wondering, Pankaj, so we spoke a fair bit about IT. How are you looking at the entire consumption boost that we were hoping would come in? I mean, we've been talking about it since the budget, really, with the tax cuts, etc. But when we're seeing what your FMCG staple companies have reported, and then you look at what your platform companies have reported, do you think that that consumption story is yet to play out, or it's been overvalued in any case?
No, not really. I'm in the first camp. I think that story is yet to play out. Maybe for longer term investors like us, we always like to be slightly ahead of the macroeconomic cycle. So we try to project trends into the future and try to place ourselves in terms of sector positioning and stock ownership, probably 2 to 4 quarters ahead of the real change happening, because that helps us or allows us to buy companies at attractive valuations, and probably helps us to build a position given a size and scale. So I think we are very much poised. Every other data point that I look on incrementally, feels very encouraging in terms of a meaningful recovery in consumption going into the second half of the year. We are in midst of a very normal monsoon, so that effectively means probably we'll have good farm incomes as well this year. And apart from the tax cuts which the government did in the budget, all of us have seen RBI has done 100 basis points of rate cuts, with the last 50 basis point being front loaded. That itself is an incremental monetary stimulus of about 15 odd billion dollars. That's about 12,000 crores of monthly savings in EMIs in the hands of everyone who's borrowed either a car loan or a home loan or a credit card loan and all of that. So the combination of fiscal stimulus which the government gave in the budget and the monetary stimulus that the RBI has injected, and on top of that now we have a normal monsoon. I think all of these are make for a perfect case for a recovery in consumption. Early signs of recovery in rural consumption is already there in some of the staple categories. We've started witnessing for the last 4 or 5 months high single digit and double digit volume growth at least, which was completely elusive for almost now 2 years. So I think we are poised for a consumption recovery as we go along in the second half of this calendar year, and that story is yet to play out.
Pankaj, so viewers, I'm going to talk about the confluence of consumption and tech, right, which you just spoke about. And Pankaj, one, credit to you. I remember we did a show with you and Sanjeev Bikhchandani on platform companies and Zomato, right? It was at 45, 50. You said there will be a recovery. There has been. You said these companies could enter the index at some point of time. Eternal is now. You had also said that Blinkit may be the new Gmail. Right now, my question to you is, now that a significant part of the rally out there has happened and there is more competition likely to come in, what's your sense from here on for the next 3, 5, 7 years? Are you constructive on the Zomatos, Swiggy, Zeptos of the world, or do you believe that you need to rethink your thesis?
One, Neeraj, I remain secularly bullish on these companies. As the second big question for investors confronting was, as these companies emerged, they challenged a lot of established companies with the traditional business models on their core business. For example, Blinkit or Zepto and Instamart are challenging the organized retailers. And the question was, who will really, have the final edge? And from my experience of having seen these companies now for a reasonably long period of time, it's very clear that the newer digital companies, they are very far. They make rapid pivots in their business. They have technological edge, and due to technology edge, they're able to give a far better user experience. And in this world of millennials, UX makes a lot of difference, and their ability to execute is at a far or their agility or ability to execute quickly is far better than the traditional companies. And given that, I've come to a conclusion that this new generation companies certainly have an sustainable edge over traditional businesses, and they will eat lunch of traditional players. This is something which has happened all over the world, and in India, I think it will be no different. So I think most of these companies have a very long runway for growth, probably over the next decade. And as I said, they will eat the lunch of traditional companies.